Hey traders, Todd Gordon here with TradingAnalysis.com. This is CNBC's Trading Nation. Traders, we're going to make a pretty bold move here. The stock market has moved into serious technical resistance, and we have non-confirmation of the stock market rally from two markets that we've talked about repeatedly here on Trading Nation, which are gold and bonds. Both are acting very strong here. That's enough for me to lean against the technical resistance in the S&P 500 and actually short this market. So I've got to make a key change. We've had the green bull lights going for a while. Let's go dive into the charts. So let's start off with the S&P chart overlaid on the two macro markets that I'm a little concerned about that are providing non-confirmation of the stock market rally. So first thing you'll see is the stock market rallied sharply since the election. So the S&P is here in white, gold and bonds are in purple and yellow. So the stock market's rallied very sharply. As you'd expect, gold and bonds were sold off because those are generally safe haven markets. So fine. As we were approaching the end of 2016, and as soon as the calendar flipped, you'll notice that gold and bonds stopped selling off. Gold and bonds have begun to rally. Gold more so than bonds. Bonds also rallied but have fallen into a bit of a consolidation. So those guys are nowhere near the late 2016 low. If you compare that to the stock market, 2016 high, we're clearly well through that. So gold and bonds are kind of waving a red flag here saying heads up. So if we flip over to the chart of the SPY, okay, now there's a lot going on here, but the first thing I want to point and bring to your attention is if you look at this daily chart, the 2015 to 2016 drop, let's call it a $30 move in the SPY. Traders use these Fibonacci extensions as upside targets, take profits, and potentially short levels. So if you take that $30 drop, you multiply it by one of the Fibonacci extensions that I just mentioned, which is 1.618, that's going to give you a target of 236. So that's number one. Number two, if you draw a parallel channel from the June 2016 low to November 2016 low, projected off the top, that's providing kind of an upper ceiling of resistance that is beginning to build a zone of resistance. On top of that, we've got the power wave, which is a kind of a proprietary algorithm that I use to find key market turning points. So for all of those reasons, there is a lot of resistance in the SPY between 235 and 240. I'm not sure we're going to be able to top tick it, but this is enough for me to start looking on the downside. I'd like to see the market begin to respect this. The warning that gold and bonds are giving us begin to play out in the stock market, and we're looking for a return down to the lower end of the channel. And if we can get that move, which brings us down to about $220, that's going to be just fine. If we break through there, that's when some serious problems will come in. But for now, let's just work down to the lower end of the channel. So the trade I'm going to do here is I'm going to go out to the April options in the SPY. I am going to look to do the April monthly. We're going to go ahead and buy the 230 put. That's about $5 away from the current market. We're going to pair that up with a sale of the 225 put. So we're going to buy the 230, sell the 225. We can do that for about 98 cents. Let's call it $1. So we're going to risk just that on the trade. We're going to pay $1 or $100 per option spread we're trading. The potential reward, as we look down here in the graph, is up around $400. So we're risking 100 to make 400, multiply that by however many contracts you want to trade. That is a trade I am very much willing to take. I'm going to put this trade to work, and that's working. Now, I'll be very diligent about risk control in this. I'm not willing to risk the entire $100 that we just put out there per option spread you're trading. I'm going to put a 50% drawdown. So if that $1 option spread gets down to a 50-cent value in terms of premium left, let's go ahead and cut that trade. We will probably at that point have broken through resistance, and we'll want to get out of this trade anyway. So top ticking markets like this or bottom picking markets is it's a very delicate process. You got to do it very humbly, do it with contained risk, but it should be part of any technical trader's arsenal with a fundamental backdrop. Now usually by the time the fundamental story comes out and giving you reasons to short the market, it's too late, the market's down a bunch already. So this is the way you kind of anticipate reversals by risking X to make 4X. Then the fundamental story will come out, attach itself to the move, but you will already have been positioned. But if not, if we get stopped out, no problem. We're simply going to move on to the next trade. For CNBC's Trading Nation, I'm Todd Gordon. Good luck on that pretty interesting trade. Be sure to follow us at Trading Nation on Twitter for updates on this as well as all the other positions that our traders are working. And we'll see you guys on the next video update.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.